Here we are with Brendon Kumar, co-founder and CEO of Layer3. Brendon, welcome to Defiant.
Yeah, thank you for having me.
All right, so let's start with your founder journey, how you got into crypto and what led you to start Layer3.
Sure. So I started my career on the investing side at a firm called Accolade Partners. It's a large alternative asset manager. Today it manages about $6 billion in capital. And I joined the firm in 2016 as a generalist. So I was doing venture, growth, buyout across tech and healthcare. And we were one of the larger investors in Andreessen Horowitz. And when they came to market with their first crypto fund, so this was 2018, the firm got an early look at it. And we concluded that we did not want to put it in our commingled funds, but it sort of had a role in the overall portfolio of the firm. So we went out to a bunch of our investors, tried to raise capital for it, and there was a lot of demand. And so it became clear to us that there was a market for offering institutions a fund-to-fund style product to early stage crypto ventures. So this is 2019, 2020. And I was one of the younger investors on the team. So I kind of raised my hand to say, hey, let's go figure out what this landscape looks like. And spent a bunch of time traveling around the country and the world, meeting folks like Jesse before he started Variant, Olaf at Polychain, the guys at Multicoin, the guys at Framework. And we built a fund in 2020 that allowed family offices, endowments, foundations to get exposure to these crypto funds. And so as part of that, I was meeting a lot of founders to do diligence on those GPs. And I was using the products, and then concurrent with that, I had also been a big fan of Ben Thompson. I don't know if you're familiar with the stratechery or the writing Ben Thompson has done, but at the time he was writing about aggregation theory as a framework to define some of the larger businesses of kind of the internet in the 2000s and the 2010s. But the premise behind aggregation theory is you're aggregating the supply side of a given network, you're providing a distribution channel, and then you build a direct relationship with the consumer, and those businesses tend to be high margin, very durable businesses. So to kind of land the plane here, I was an active user of a lot of the protocols that I was meeting, these founders for, doing diligence on the GPs, and it became very clear to me that there was a gap in the market for connective tissue between protocols that are trying to acquire users and consumers who want to find protocols that are relevant to their needs and interests. And that was the loose idea that I, had gotten excited about. And then during that period, I also met my co-founder. And obviously, I come from an investing background, so it was important to me if I went to the operating side to find someone who just had world-class experience on the product side. And he did, and had been thinking about a very similar problem, and had actually started Layer3 under the same branding to focus on something somewhat adjacent. And so we decided, very complementary background, and we started the business in September of 2021.
Okay, so the idea was to match this need that you saw of crypto projects to find users, and of users to find the different crypto projects that they need. Okay, so now can you talk about what the solution looks like with Layer3?
Yeah, so it's a two-sided marketplace. On one side, you have large Layer 1 and Layer 2 ecosystems. So think Base, Linea, Optimism, Arbitrum. And then on the other side, you have consumers who come to our platform for discovery and to earn. And so we will typically negotiate larger contracts on an annual basis where Optimism or Arbitrum are giving us OP or ARB tokens. And then we take those tokens and we route them through a distribution protocol that we've built. Distribution protocol does a few things. The first is it says if the user has done X on chain, meaning you bought an NFT on Magic Eden, you provide liquidity on Uniswap, then you get Y reward. And Y is a function of two things. It's a function of your cost, so how much you spent on the network, and then the value of the action. So it's dynamic, and it allows protocols effectively to reach and incentivize users in a much more precise way than airdrop farming or some of these other CAC tools. And then the consumer side, it also allows you to have very personalized experiences. So coming back to the point I made earlier, prior to the introduction of Layer3, if you wanted to find protocols that were relevant to kind of your needs and interests, it was just scrolling through Twitter and spending a bunch of time in Discord. And if you think back to the early internet, that was not how you found what you wanted. You had Google, you had an aggregator. So we filled that void for the consumer, and in doing so, they're able to earn directly on Layer3. There's an identity component to it, but I'll pause there.
Okay, so sounds like there's two different use cases. One is actually earning tokens. So getting rewarded for your actions on chain. And then the second one is finding different Web3 dApps, right? Okay. For the second one, for finding dApps, is it like are you kind of building a registry of dApps, or like what's kind of the end goal there?
No, so think about it. The simplest analogy is Google, right? So, or maybe let's take Facebook, because I think that might resonate with the audience a little bit more. So if you're a consumer on Facebook, right, you're attending the platform for kind of social and interaction. But let's say Nike's advertising, and I'm a male between the age of, call it, 20 to 35. So and I like running. So if Nike's advertising running sneakers, that's going to show up in my feed. And it's a very similar model for us, which is that we've built this gamified interface for consumers to spend time on chain through Layer3. And then on the B2B side, we will go out and we'll serve primarily Layer 1 and Layer 2 ecosystems, because the premise is you need to help your builders reach users. And so you can use Layer 3 as a distribution channel to do so. And we typically only want to work with the best protocols. So we want to work with ones that are high quality, they're audited, they have well-built, robust front ends, and it really meets the need for the end consumer. But it's no different than, again, Facebook's model, where you have an advertiser show up and say, hey, I want to reach users. I have a product that I'm trying to get in front of a consumer, and our platform allows them to do so.
I see, okay. Okay, so it's the projects or the dApps and protocols that want to reward users through Layer 3 are the ones that are featured in the platform.
Correct, exactly.
Okay.
If you're spending on Layer 3, then you will you'll be featured. And again, we do a very strict policy around curation, because the primary objective for us is showing users things that are again, high quality and interesting. And you know this, right? Because you've been in the industry for a long time. But the barrier to entry to bring something to market is so low that there's this huge long tail of just low quality, spammy projects that consumers don't find relevant or helpful. And so a part of our role and a part of our moat as a business is curation. It's only working with the best teams. I
see, okay. Are the rewards routed through Layer 3 different from what maybe the dApp is already doing in their own platform?
It is. So if you think about the evolution of kind of customer acquisition in crypto, you had ICOs, which was kind of capital as a way to attract your community. Then you had liquidity mining, then you had airdrops, and then earlier in the year you had kind of like the points meta. And each of those are extremely inefficient methods, because you're spending, for liquidity mining and for airdrops and for points, you're spending on average $1,000 to $5,000 per customer when all is said and done. And then
really, is that?
If you look at average airdrops, right, maybe it's probably $500, but $500 to $5,000 you're spending on this consumer, okay? And then if over a 6-month period you look at the retention being, is that user still actively using the protocol, it's less than 10%. So your CAC is extremely inefficient. And then the way we think about our product is, if you are a protocol and you're routing OP or ARB through Layer 3, on a 6-month basis, you have 60% net new retention, because you are only rewarding users based on actions that you want them to take, and you're finding users that are really high quality. And maybe now's a good time to introduce the identity component. So in a very similar way to as you kind of spend time on Instagram or Facebook, you develop this digital footprint about your interests. And in crypto, by nature of the fact that it's open source, you can sort of get an understanding on what a wallet's interests are. And then we add an extra layer to that with this identity primitive that we called a cube. It stands for Credential Unified Blockchain Events. And the premise behind a cube is that if a user does something on Layer 3, we know that they have an interest in that specific vertical or category. So an example might be they're trading NFTs. And so our infrastructure says, well, this user has a propensity to trade NFTs. They have a higher wallet balance. And so if Magic Eden wants to attract that user, we have the infrastructure that allows them to do so.
Okay. But trying to understand, so the idea that dApps want to reward users for actions they want them to take, that's already the principle of airdrops. Yeah. So how are you helping them better refine that process?
So an airdrop is retroactive, right? It's we want the user to go take these actions. Sorry, if you took these actions, we will reward you. And that was awesome in the first instance because no one expected it. But then we created a paradigm where now you have a whole economy of people who are actively using protocols because they expect to have an airdrop. Now, where we differ is it's a forward-looking action. I have $100 in OP that I want to reward a user. I want that user to have a wallet balance above a certain amount. I want that user to do this really high quality action, and I only want to target users who have proven that they are retentive in this category. And so it allows you to more precisely spend your treasury. And the rough heuristic is, if you look at the past 20 years, 40 cents on every dollar raised was spent through Facebook or Google. And that's why they're such high margin businesses, because every venture-backed company needs one thing: they need distribution. And so they spend a lot of money through these distribution channels. And the same is true in crypto, where I believe if you take the treasury in the fullness of time, roughly 40% of that treasury is going to be spent on quote unquote growth. I think today it's very inefficient. You have 5 to 10% that goes towards airdrops, maybe another 5% that's sold down to USDC and spent at places, like conferences and these types of events. And then call it another 5 to 10% that's spent in other probably really inefficient ways moving forward. And what we enable is, well, you can spend $100 here, $1,000 there, $10,000, and it's very efficient, so you can measure it quickly, and you have a quick feedback loop on whether or not that spend is working.
I see. How many dApps are using Layer 3?
We serve 32 different chains today across the EVM ecosystem and Solana, and then roughly 600 individual apps across all of those chains. So at this point, it's quite robust. We're 3 years old. We've driven over 150 million on-chain actions that are attributable to the Layer 3 network, and more than that in credentials.
Nice. And how many users?
Roughly 6 million users have connected a wallet and transacted on the Layer 3 network. On a monthly basis, it really fluctuates anywhere between kind of 500,000 to 700,000 users are actively spending on Layer 3 and earning through our credential network.
Wow. How much in fees are you taking, or like what's your business model?
Yeah, so again, thinking back to aggregation theory, part of the reason that this business is such a robust business is because you are serving every part of the market. So if you're building a chain, if you're building an app, if you're building a game, if you're building an NFT marketplace, you need distribution. So the way we think about our revenue streams is there's 3 core components. On the B2B side, you take a percentage of the throughput. So if Optimism gives us, call it $1 million in OP, we'll take a certain percentage of that in the native token that sits in our treasury. We then try to become an active member of governance and an active member.
Like what percentage do you take?
Roughly 20%. Again, it varies. And then on the consumer side, there are 2 revenue streams. The first is trading fees, which is a natural complement to our product, because if you're earning, let's say, OP on Optimism and you want to now move it to another super chain, you can bridge on Layer 3 without leaving the product, so we take a fee there. And then there's a credential fee. So depending on the price of ETH or SOL, it's typically 25 to 30 cents. The user pays that to earn the reward and mint the credential. So you have a pretty nice complement across B2B, B2C, and I'd say it's a relatively even split across the 2.
Going forward, what's your, what are the next steps for you? What are the big milestones that you're working towards?
So I think the best model here is if you own the consumer relationship in crypto, you can find ways to offer those consumers more in the on-chain economy. And so we started by saying, well, if you want to discover, come to Layer 3. And then we started offering trading experiences, just building on top of Socket and Li-Fi. Trading is a huge untapped market for us because consumers naturally want to move assets around. As you know, we're kind of entering this golden period where it's a proliferation of markets. Consumers want to trade any market, any asset, any outcome all the time. And we believe that we can build more trading experiences. So our goal is to offer more natively in the product, no different than how Google said, well, we have a captive audience with search. We're now going to start to offer them cloud and email. And we basically want to penetrate more of the consumer experience while also being a complement to all the partners that are trying to obviously acquire users on Layer 3.
So are you thinking something like a DEX?
Something like a DEX. I would say we're going more towards trading infrastructure that's in line with spot and derivatives trading around kind of a centralized experience. We want to allow speed, facility. And then the other thing is if you can, the business has natural complements. So if you serve more of the consumer, meaning your distribution channel is stronger, consumers come to Layer 3 to do more. That enables pricing power on the B2B side. And that pricing power allows us to go to these teams and say, now not only are we getting you users on chain, but we're also going to help you get liquidity for your token. And we're also going to help you find new buyers for your token. And there is a reason that the most dominant businesses in crypto are exchanges. because they have distribution, but that distribution is for buyers of the asset, not users of the protocol. And so we have built distribution for users of the protocol, and we now want to build that distribution for buyers of the asset.
I see. Okay. And so in the long term, like, where would you want to be if everything goes right, say 5 years from now?
It's the largest and most used consumer-facing product in crypto. There's this like probably more suited for Twitter, but kind of notion of a chain-agnostic super app, and there are many takes on it, right? You have the kind of very trading-oriented take where like Kane with Infinex is building, but our point of view is the on-chain consumer has a different motive. They want to spend time learning, earning, discovering, and then you can backdoor your way into the trading. And so we believe we can build one of the best trading experiences in the market, one of the best earning experiences in the market, and therefore be the leading aggregator and distribution network.
So what would that experience look like? Do you hope that users would come first to layer 3 because they want to earn, they want to be rewarded for their on-chain actions, and then once they're there, then you get them to perform, you help them with trading and you help them like to do other things on chain, or what does it look like?
So there's going to be different motives depending on the type of user. So the way I break out consumers in crypto today, you have 3 buckets. You have consumers who want to work to earn on chain, and that is actually a novel element about like sort of the internet that crypto has enabled. We saw this with Axie, we saw this with some of the other play to earn games, and so that behavior is a cohort. Then you have another cohort who are traders, and both of which have profit incentive. They either want to work to earn or they want to just trade their capital to earn. And then you have a third cohort, and that third cohort are people who don't have access to traditional financial markets and will be brought on chain through stablecoins, so the 1.6 billion unbanked population. That third cohort for us right now is less of a priority. Those are people who I think are going to be primarily using traditional products through like a bridge API and getting access to financial services. But the first two are where we want to build products, and we very well might acquire users who are coming to work to earn, and our product enables that, and that's a very popular market, and it's a huge market. And then we also want to enable products where if you're trading, you can trade through layer 3. The point though is that when you think about consumer in general, consumers want two things in any business. They want profit or they want status. So if you think about just all consumer businesses that have ever worked, social media platforms, they're offering status. The new neobanks and fintech products, they're offering profit. We believe that we're uniquely positioned to couple both, where you can get both profit and status directly through layer 3. And as you extend kind of some of these demographic trends that have happened where more and more people are starting to participate in markets, you have this TikTokification of markets happening over time where people who otherwise weren't investing or speculating are now coming to invest and speculate. The interfaces with which they do so are going to be gamified and more social in nature, and that's where we have really shined as a product. So to answer your question, it's a combination of both.
Because like so many of your users might be looking to work to earn, how do you improve that proposition for the dApps who want that retention? Because if it's a user that is just there to earn the token and then leave.
So by and large, I think airdrop farmers have a very bad reputation for a good reason. But there are a cohort of people who genuinely just enjoy spending time on chain, and their goal is they'd rather use these products and compound their wealth that way. And we now have roughly 4 years of users in typically parts of Eastern Europe, parts of Africa, parts of Asia that have compounded significant value in doing this. And these users retain. Not only that, they're also extremely high quality users in giving product feedback. So one of the features that we've enabled is Layer 3 has now been around for 3 years. We've built a very large audience. These users use pretty much every product that we put in front of them. They have a very refined eye for what they like. And so we're able to not only help on the B2B side, the protocols acquire users, but we're also able to get them product feedback that improves retention, improves the product experience, improves UX flows. And that also enables our value prop. But to answer your question, I mean, the audience that we have, if you look, the retention numbers are extremely strong across the board, and all of this can be found on Dune, but roughly 60% net new user retention over a 6-month basis. And the wallet balance is in the kind of the $5,000 to $10,000 range. And again, these aren't whales. but these are real users that are transacting in meaningful size.
Interesting. Great. And what's the kind of very next thing to look out for from you?
The next thing, we have a few bets. So I mentioned, trading. There are two types of trading. You have your traditional spot and derivatives, and then you also have speculative experiences, so polymarket style experiences. We launched a product called, Layer3 Predictions that offers a fresh take on kind of the speculative style experience. So that's now live. It's live on Solana. We're going to be bringing that to some of the L2s. The second is economic upgrades. So we haven't talked much about the role of kind of the Layer3 token, but we announced some economic upgrades to the network where some of our revenue, basically all ETH denominated revenue, will be automatically buying back the Layer3 asset. And you can also spend using the L3 token. And then the third, which will be announced this week, is a term that we're calling conversational finance, but allowing users to connect a wallet to an LLM and basically direct that LLM to do anything they want in the Layer3 ecosystem or more broadly. So that'll be launched under a separate brand this week.
Super exciting. Great. And then for our viewers who want to get started with Layer3?
Yeah, head over to layer3.xyz, create an account, and then follow us on Twitter at layer3xyz.
Awesome. Thanks so much, Brendon.
Yeah, thank you for having me.